Welcome to Apex Macro. Imagine stepping back into the summer of 1944. The Second World War is still raging across Europe and the Pacific. Entire cities lie in ruins, factories are destroyed, supply chains have collapsed, and millions of people face hunger and uncertainty. The global economy is in tatters after more than a decade of chaos. To understand why the Bretton Woods system was created, we must first look at what went wrong before. After the stock market crash of 1929, the world plunged into the Great Depression. Countries abandoned the classical gold standard one after another. Britain left in 1931, the United States in 1933. Nations then engaged in competitive currency devaluations and raised tariffs, most famously the Smoot-Hawley Tariff Act of 1930 in the United States, which triggered a global trade war. Historical reconstructions published by the League of Nations and later reviewed by the IMF indicate that world trade collapsed by more than 60% between 1929 and 1933. U.S. Bureau of Labor Statistics historical records show unemployment soared to 25% in the United States and similar levels elsewhere during the early 1930s, and economic nationalism replaced cooperation. Central bankers and economists realized that without a new cooperative framework, the same destructive cycle could happen again after the war. In July 1944, in a grand hotel nestled in the mountains of Bretton Woods, New Hampshire, 730 delegates from 44 Allied nations gathered for 3 intense weeks. They were not soldiers or politicians debating battle plans. They were economists, finance ministers, and central bankers determined to build a stable international monetary order. 2 main plans were discussed. The British proposal, led by John Maynard Keynes, calling for an international currency called Bancor, and the American plan, led by Harry Dexter White, that centered on the U.S. dollar backed by gold. Given America's overwhelming economic strength, holding about 70% of the world's gold reserves at the time, the U.S. plan prevailed. What they created became the backbone of the post-war global financial system for nearly 3 decades. Today, we explain the Bretton Woods system, its core structure, the economic mechanisms that made it work, the historical forces that led to its end in 1971, and what this major regime shift continues to mean for the global economy, businesses, and investors today. This is an educational macroeconomic analysis, not financial advice. At its heart, the Bretton Woods system established a gold dollar standard. The United States committed to convert dollars into gold at a fixed rate of $35 per ounce exclusively for foreign central banks. All other major currencies were then pegged to the U.S. dollar within a narrow band of plus or minus 1%. This created an adjustable peg framework designed to combine the stability of fixed exchange rates with limited flexibility for countries facing fundamental economic imbalances. The first transmission channel operated through sharply reduced currency risk. With predictable exchange rates, businesses could plan long-term international trade and investment with much greater confidence. According to IMF historical statistics covering the period 1950 to 1970, world trade expanded at an average annual rate of around 8% under this framework, far higher than the pre-war period, helping rebuild Europe and Japan at an unprecedented pace and supporting the so-called golden age of capitalism. The second transmission channel worked through sustained U.S. balance of payments deficits. As the world's largest and most productive economy, the United States supplied the global liquidity the growing post-war economy needed by running deficits that steadily increased dollar holdings abroad. In simple terms, think of the dollar as the world's primary reserve currency anchored to gold, functioning like a trusted global settlement system that kept trade and capital flowing smoothly across borders. To understand how this actually unfolded in practice, we examine 2 key historical references in detail: First, the Bretton Woods Conference itself in 1944 successfully established two cornerstone institutions that gave the system its operational backbone. The International Monetary Fund was tasked with monitoring exchange rates and providing short-term financing to countries facing temporary balance of payments difficulties. The International Bank for Reconstruction and Development, later known simply as the World Bank, focused on long-term loans for post-war rebuilding and economic development projects. These institutions helped channel capital where it was most needed and prevented the kind of sudden stops that had plagued the 1930s. Second, by the late 1960s, the famous Triffin dilemma, first highlighted by Belgian-American economist Robert Triffin in 1960 during congressional testimony, became impossible to ignore. The United States needed to run persistent deficits to provide the dollars that the expanding global economy demanded for trade and reserves. Yet those very deficits gradually eroded international confidence in the dollar's gold convertibility. Federal Reserve historical balance sheet data show that U.S. official gold reserves declined significantly during this period, falling from approximately $24.8 billion in August 1949 to around $10.1 billion by 1971. On August 15, 1971, President Richard Nixon announced the temporary suspension of dollar-to-gold convertibility for foreign central banks, an event known as the Nixon shock, effectively bringing the Bretton Woods system to an end. This marked a clear regime change from the gold exchange standard that had operated between 1944 and 1971 to today's system of fiat currencies with predominantly floating exchange rates. The mainstream explanation holds that the original framework had become unsustainable amid shifting global economic realities, rising U.S. inflation, and the growing economic weight of Europe and Japan, and that the greater monetary flexibility after 1971 ultimately supported the explosion of international trade, financial innovation, and globalization in later decades. However, this perspective may be incomplete because the immediate post-1971 years brought notable increases in inflation, reaching double digits in many countries during the 1970s, along with significant exchange rate volatility that created new challenges for businesses and policymakers. A balanced macro interpretation recognizes that monetary regimes are not permanent structures. They evolve in response to changes in underlying economic power, policy priorities, to technological advances in finance and shifts in global trade patterns. The current fiat regime has coincided with enormous growth in global trade volumes, the development of deep and sophisticated financial markets, and unprecedented integration of emerging economies, while placing greater responsibility on central banks to maintain credibility through transparent and consistent policy frameworks. For businesses engaged in cross-border operations, the shift to floating rates fundamentally transformed risk management practices. Companies that once relied on stable pegs now had to develop active currency hedging strategies, use forward contracts and options, diversify supply chains across multiple countries, and build more flexible pricing models to navigate daily exchange rate movements. For example, multinational manufacturers in the auto and electronics sectors had to invest heavily in treasury departments to manage currency exposure that previously did not exist at the same scale. For portfolio managers and long-term investors, the lesson is equally important. Asset classes and investment returns perform differently across monetary regimes. During the fixed-rate gold-dollar period, government bonds in major currencies offered relatively stable real returns, while after the shift, commodities such as gold delivered strong performance during the high-inflation 1970s. Understanding these structural shifts helps investors construct more resilient portfolio allocations that can adapt when nominal anchors change, for instance by maintaining appropriate diversification across currencies, hard assets, and inflation-protected securities. The key takeaway is regime awareness combined with disciplined risk management. Rather than reacting emotionally to short-term headlines or policy announcements, investors benefit most from maintaining a long-term perspective on how large-scale economic forces shape opportunities and risks over decades. What do you think about the legacy of the Bretton Woods system? How does this historical regime shift affect the way you view the global economy and your investments today? Thank you for watching. Subscribe for more clear, data-driven macro analysis every week.